This week on Wealth Track, are you better off investing like a robot? Dorfman Value Investments' John Dorfman discusses why his robot portfolio performs so well, but is not for most investors. How he uses it in his own portfolios is next on Consuelo Mack Wealth Track.
This week's guest has a much simpler approach, which, much to his surprise when he first tried it 17 years ago, does work. But it comes with a large caveat. It is not appropriate in the vast majority of portfolios, and he only applies some of it himself. He is John Dorfman, chairman of Dorfman Value, an investment management firm he founded in 1999 that manages money in separate accounts for high net worth individuals, family offices, and a few institutions. Dorfman created his 10-stock robot portfolio to test the theory that statistically cheap stocks will outperform the market over time, and lo and behold, they have. He starts with all U.S. stocks with a market value of $500 million or more. Then he eliminates those with debt greater than equity. Then he picks the 10 stocks selling for the lowest price earnings multiples of the past year's earnings. I asked Dorfman why he doesn't just use that method.
We've asked ourselves that question a lot. I wouldn't put money directly into the robot portfolio, directly and exclusively, unless if I were very wealthy and I were taking 5% of my portfolio, by all means. But it's a high-risk portfolio for any number of reasons. One is the stocks are severely out of favor. Two, it's not diversified. Some years you'll get 5 housing stocks or 5 oil stocks out of 10.
Right.
And so you don't have diversification by industry, you don't have diversification by country. But these are the most severely out of favor stocks, and while they're high risk, as you know, the returns have been spectacular over the years.
And you, of course, are a value manager. So what lessons, or are there lessons that you can apply from the simple, very straightforward methodology that you use in the robot portfolio to your portfolios and to our portfolios?
Well, I certainly do try to do that. And right now, for example, we typically hold about 25, 26 stocks for a typical client. Yeah,
right.
We're pretty concentrated. And about 5 of those names came in whole or in part from the robot portfolio. So we attempt to cherry pick names out of it. And I must say, there are years when the robot will generate 10 names and there'll be maybe one that I would say, I wouldn't touch that with a 10-foot pole, and maybe that's the best performing one. So our cherry picking sometimes adds value and sometimes reduces value, but we find it a fertile source of names over the years, and that's how we use it.
As I just explained to our viewers in my introduction to you, what the methodology is for the robot portfolio, but what methodology do you use in real life for your portfolios?
Well, we are partial to severely out of favor stocks, and we like to have a good sprinkling of kind of obscure, off the beaten path names. That said, our process is a name comes to our attention either because we think it's a good company that's been hurt by bad news, or because it shows up on the screens that we like to use, of which the robot is one of the primary ones. And then we look at it from the point of view, first, valuation, not only price earnings, but also price book and price sales. And we use price cash flow as kind of a cross-check, not as a primary selection metric. Then we look at the balance sheet. Right away, we rule out stocks whose debt is greater than equity. I think in 17 years, I've probably only owned 2 or 3 of those. For the most part, we just won't go there. And that eliminates a third of the stocks in the market right off the bat.
Where are you finding values now? I mean, in which asset class?
Well, I'll give you a 2-part answer to that one, Consuelo. First of all, right now, I'm finding it just here and there. We touched on Cooper Tire earlier. That still is a very good value, I think. Spirit Aerosystems, which makes fuselages and wings for Boeing and Airbus, I consider a good value in today's market. Some of the auto parts stocks, I think, are still very well priced and took a hit in early January. So if they were getting up there a little bit, they're knocked down to more attractive levels. So very much rifle shots, individual things. But sometime this year, I think there'll be a titanic buying opportunity in the whole energy sector because it's been so hurt for 18, 19, 20 months. And the question is, will they have a final selling spasm before
Right.
a recovery begins? And my feel as a person who's been in the investment world for 30 or 40 years as a writer and 20 years or so as a portfolio manager is it feels to me like the selling climax hasn't happened there yet. So I'm holding off, and I may regret it, but I think there'll be a better time to buy them than early in this year.
Right. And describe, so the trigger would be a selling climax. So describe what that would entail. I mean, is another leg down of like 10% or?
I suspect it's at least 10% decline from the early year levels. And the signs, I think, of a selling climax, first of all, we'll see a few more bankruptcies. I know there have been a couple dozen already in the energy patch, but I think there will be a few more, and including a more prominent name than what we've seen so far. And the other sign of a selling climax would be, okay, the stocks will not look attractive on price earnings because there won't be any earnings, but
Right.
they'll look cheap on price to sales or price to book. And at that point, I hope and expect I would have the courage to load up.